A lot of people are saying the bear market rally is over. I think that's probably a bit premature. The catalyst for this is concerns, again, that the Federal Reserve might sort of tip its hand this week in Wyoming, the big Jackson Hole Summit. That's the one that Jerome Powell speaks at, I believe, on Friday, where he will probably echo what we've been hearing from a number of district presidents and Fed governors who err on the side of being a little bit extra aggressive when it comes to interest rate hikes. As you know, a number of them have been saying, continue to make it 3/4 of a point on the overnight bank lending rate. Let's get the read on all of this with Jonathan Honig with us, the Capital's big hedge fund manager. We've also got Michelle Schneider joining us. Michelle, from your vantage point here, suddenly we're back to worrying about the number of increases we're going to see and how big they are, where before we would herald news that hinted of a slowdown that oddly enough would limit those increases. So it's a chicken and egg argument, but what do you make of it?
Well, I never was in the camp that the Fed was going to pivot or soften their stance on the fight against inflation. I think it was a very hopeful market, but it's also very typical of a stagflation environment where you're going to see rallies and you're going to see trading ranges. And this was really a great time to learn how to read a chart if you didn't know how to do one before, because all the indices cleared their 50-day moving average, gave you a good buy signal. They all failed their 200-day moving averages, giving you a good sell signal. And now here we are smack dab in the middle. So the key is what happens from here. And certainly, I don't think that we're going to see anything different from the Fed. We still have major inflation issues. And now we have new issues with drought in the Yangtze River, not being able to get ships in and out of it because the banks are dry. Right. So there's so much going on with Mother Nature. And that's going to be another fuel for inflation, even though we've seen somewhat of a plateau here.
Yeah, she was wise to mention that phenomenon here, how this drought is going to affect likely, a lot of food and related items that are going to rocket in price, if even temporarily. So, Jonathan, that combined with news out of Europe that they're looking at an inflation rate that could still be in the double digits well into next year, record high inflation rate in Britain. Now, we have not seen anything quite like that, but individual items that we're showing here, like in key food items, continues to run at a breakneck pace. So how do you sort this out as an investor?
Unfortunately, Neil, I mean, inflation is a longer-term phenomenon. This is not, as they say, the toothpaste that can be quickly stuffed back in the bottle, especially given the size of government spending these days. This is and the market is reflecting that. And, there's been long periods of time, especially the 1970s is the best example, where stocks, because of that inflation, basically went nowhere for years. 1968 to 1980, the market was flat while the economy was dealing with all that inflation. Michelle was spot on in her analysis of the stock market. 70% of stocks are still below their 200-day moving average, Neil. And so, the Fed, once again, behind the curve here. I mean, the curve is so tremendously inverted. That's a bad sign. It has always heralded a recession, and yet the geniuses in Washington haven't even declared a recession yet. So I think we're not even in for some pain, but for some flat, boring markets, much like we saw in the 1970s or even the first decade of the 2000s.
We talk about this inverted yield curve, Michelle, where 2-year notes, for example, are trading at a much, much higher rate than 10-year notes. In fact, it's the widest it's been in quite some time. A lot of people do look at that as yet another recessionary signal. Do you?
Well, it's certainly a factor that you can't ignore, but everything has changed in terms of the metrics. And what it's really reflecting is the chance of recession, and then certainly we're already in the technical recession. So the key is going to be now what happens with that yield curve if we're looking at the classic ways that we really see in a recessionary time, which would be housing. And many people are calling for a housing bubble. I don't know if I necessarily see a bubble, but I certainly see a correction continuing. And 2 would be labor, which right now is the holdout because it's still relatively strong, even though that doesn't reflect the labor participation, which really hasn't come back at all. So I think you got to look at all of that combined. And just to pick up what Jonathan said, this inflation thing, putting the genie back in the bottle is not so easy, even with higher rates. Some things may not necessarily be impacted by that. And that also could wreak more havoc in terms of these yield curves because the Fed will have to continue to fight to raise till they get to the point where they just destroy any demand.
So was this a head fake then, this whole rally from our lows, Jonathan, or are we making too big a deal of it? A lot of people say, well, that's it. The bear market rally, whatever you want to call it, is over. I kind of think that's a bit premature, but your thoughts?
Well, I think the market tires people out, Neil. It frustrates Yeah. I mean, it frustrates the bulls and ultimately the bears. And what's so frustrating as an investor is that inflation, in effect, forces you to think short term. As an investor, even as a homeowner, how can you plan 3-5 years out on the rate of anything, knowing that prices are rising so quickly, and again, not being yet addressed in Washington? So I think you are correct that the jury's still out as to whether this is a bear market rally or not. But this is still a bear market, and often those last for a long time, longer than other people would think. I mean, 1934 to 1950, Neil, again, a flat period of the markets. This is not uncommon to have that kind of choppy action that just tires everyone out.
Well, something of that duration would be. So we'll watch it very closely. Guys, I want to thank you very, very much. In the meantime...